Inflation came in at 3% year over year. It was a modest win for the market, but don't get too comfortable. The real story? Tariffs, vehicle prices, and major auto earnings are colliding, and the machine, it's still turning. So your truth bomb for today is that tariffs aren't crushing corporate margins just yet. Consumers are. Merrily, we roll along. Let's start with a headline that everybody saw. Inflation came in lighter than expected. The long-delayed Consumer Price Index report finally dropped, and it delivered exactly the kind of news that the market was hoping for. After 3 weeks of waiting, thanks to the government shutdown, we finally got a glimpse into the price landscape. Consumer prices rose 3% year over year. It was a tick higher than the last reading, but still just below expectations. That was all the market needed to literally light up. Stocks rallied, bonds stabilized, and every talking head on television started murmuring about rate cuts. But before you break out the champagne, let's remember why this number even exists. The Bureau of Labor Statistics only released it so the Social Security Administration could determine its cost of living adjustment. That's the COLA. Not exactly a market-focused gesture, but hey, we'll take whatever we can get these days. Now, let's talk about what's inside the number because the headline 3% doesn't really tell the whole story. Inflation is like an iceberg. What you see above the surface is only a fraction of what's actually going on below. Start with services inflation, the sticky stuff. That's where housing and medical care live, the two giants of the services economy. Housing still makes up roughly 60% of the entire services inflation bucket, and it's been slowly and painfully declining. Prices are still rising, just not as fast. Meanwhile, medical care services are starting to turn up, with hospital care costs running almost 6% higher than a year ago. That's above the long-run average, and it's keeping the services side of inflation from falling faster. So yes, services inflation is getting better, but it's still sticky. Now, let's shift gears to goods inflation, where the real story begins. Goods inflation is where the impact of tariffs show up, and it's where the Fed's biggest fear lives. When you break it down, transportation commodities like cars and trucks make up about a third of all goods inflation. Add housing, furnishings, and apparel, and you're covering nearly 2/3 of the whole category. These are the places where tariffs hit first. Steel, aluminum, auto parts. These inputs get taxed at the border, and cost flows straight into consumer prices. It's supposed to be a straight line. Tariffs up, prices up, margin down, consumers mad. But there's the twist. If you look only at CPI, you'd think automakers were being crushed under the weight of tariffs, supply chains, and input costs. But last week's auto earnings told a completely different story. Both Ford and General Motors stepped up to the mic, and instead of warning about margin compression or consumer weakness, they basically said, "We're doing just fine." Ford CEO Jim Farley opened by saying that the company beat expectations and that if it weren't for a single-fired and aluminum supplier, they would be raising full-year guidance. That's not exactly the language of a company under pressure. That is a CEO flexing. He even thanked suppliers, dealers, and wait for it, the administration for tariff policy that levels the playing field. That's a polite way of saying that tariffs are helping us. General Motors had the same energy. Mary Barra said GM delivered another strong quarter of earnings and free cash flow, and that they were raising full-year guidance. She thanked the president and his team for updated tariff framework, calling it supportive to domestic manufacturing. Wait, stop and think about that for a second. Two of America's biggest legacy manufacturers, long considered the frontline victims of trade policy, are now calling tariffs a net positive? That's a plot twist that nobody had priced in. GM explained that earlier in the year, it expected tariff costs as high as $5 billion. But by last week, that number had been cut to $3.5 to $4.5 billion, and that even that was being offset through pricing and footprint shifts. They expect to recapture about 35% of the costs. Net impact, $2 to $3 billion. Still big, but far from devastating. GM CFO even said that they expect next year to be stronger than this year. Ford's story was similar, but even cleaner. They cut their expected tariff costs in half from $2 billion to $1 billion. They took a $700 million tariff hit in the quarter and still printed $2.6 billion in EBIT. Warranty costs dropped by $450 million year over year, and quality scores improved. And get this, AI-driven plant upgrades are cutting defects in real time. That's not an industry in trouble. That's an industry that's adapting. In fact, GM and Ford are telling a story that flips the conventional wisdom on its head. Tariffs are supposed to be taxes on trade, but in practice, they're turning into incentives for domestic production. Both companies announced they're adding jobs, adding shifts, and building more vehicles in the United States. GM is doubling Equinox output in Kansas, adding a $1 billion energy program in New York. And Ford is adding 1,000 jobs across Dearborn and Kentucky to boost truck production. That's exactly what industrial policy is supposed to look like, even if it's wearing a tariff mask. So what does this mean for inflation and for the Fed? First, goods inflation isn't going away because the cost of vehicles remains high. The average new car price in America just crossed $50,000 for the first time. That means affordability is stretched, but companies aren't blinking. Ford said its incentives are still below industry averages, and GM is maintaining price discipline. That's the real tell. If automakers can hold price, maintain margins, and keep production strong, then tariffs aren't hurting them. They're hurting you. The consumer is taking the hit in higher prices, but the companies are keeping their profits. That's the part that the market doesn't want to talk about. And when you pair that with the Fed's current mindset, it gets interesting. The Fed wants to see inflation down to 2%, but tariffs and localization are pushing the other way. Goods may be getting more expensive, but the employment and wage side is getting stronger. The Fed can cut rates, but if domestic production stays hot, it may not need to. So we're in this strange period where the economy looks like it's cooling on the surface, but underneath, it's simmering. The headline CPI number looks friendly, but the structure behind it is shifting. The old textbook said tariffs would cause margin compression and layoffs. Instead, we're getting reindustrialization and rehiring. That same old textbook said consumers would push back against price hikes. Instead, they're still buying $50,000 trucks. This, my friends, is not your grandfather's economy. This is a new kind of hybrid where tariffs, automation, and domestic incentives are mixing to produce strong corporate earnings and sticky inflation, all at the same time. And if you're wondering how long that can last, well, remember this. Markets can celebrate a cooler CPI for a few days, but if input costs and vehicle prices stay high, those gains will be short-lived. So stay sharp, because this story, it's still unfolding. And your truth bomb for today is this. Tariffs aren't crushing corporate margins just yet. Consumers are. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.